which has been doing well too. From smooth drive, we move on to a smooth shave, and that is Gillette. Good numbers coming in. Gillette reported their numbers post-markets yesterday, and the revenue grew by about 10%. Importantly, the EBITDA grew by about 20%. The net profit was lower on a comparable basis, but that's largely because the other income came half of what it was the same time last year as well. So no real concerns out there. What did well for them was the grooming segment. The grooming segment revenue grew by about 13.5%. Grooming segment is the one that sells all the razors, the shaving equipment, as well as some of these, trimmers, etc. EBITDA out there jumped by about 30%, which implied a margin growth of over 300 basis points from 18.5% to a little around 21.6% itself. So the grooming segment did well for them. Oral care, which is, the products that they sell under Oral-B, did not do too well. That was down by about 4% on a revenue front. That's largely on the base of a 6.5% growth that it saw same time last year. But there too, the margins improved from around 15% to 17%. Gillette in the past has gained market share in their core blades and razor segment on account of a couple of factors. The first one, they've increased their distribution. So distribution, expansion initiatives have done well for them. There's been a solid response to the Venus line of products that they've removed. That's the female hair removal range, and that's gone to be a growth driver for the company, increase the TAM, and then the increased salience coming in from electronic products like trimmers and shavers. And now female range, last year was about 7 to 8% of their sales, has increased all the way to up to 15% of their grooming sales. So that's doing extremely well for Gillette as well, and that explains the kind of 7% up move that we're seeing on the stock. So earlier it was the best a man can get, now it's the best perhaps that everyone gets.
Okay, all right, so that's on Gillette. But